Welcome to the webinar. I'm Raghee Horner, and without further ado, let's go ahead and get started with our webinar here. Let me kind of tell you all what we're going to talk about here during the next hour or so. So I have slated a number of topics that I want to make sure we cover. I want to do so while we're looking at the live market. We're going to talk about support and resistance and all those types of things we normally expect a trading webinar to discuss, but we're also going to be adding in, this is about my favorite tools. I mean, that's what I wanted to share with you today, because if for nothing else, one of the things that a lot of people seem to have this misconception about is that I don't want to use the word professional trader. I just consider myself, I make a living as a trader. And as a trader, as an analyst, as a writer, as a blogger, as someone who records videos and all that kind of stuff, there's, that's what I do. And there seems to be this assumption that somehow if you're doing all that, you must know everything about the market. And I'm the first one to tell you that it still amazes me how much I don't know. It still amazes me. Every year I go, wow, I just did not know that about price action behavior. I just did not know that a trend could do that, or the volatility could be this way. I mean, the market still astounds me. But I think the bottom line is, when it comes to being a trader and someone who shares their analysis, and if that's what you do, there has to be consistency. And for anybody who's been reading and watching what I've been doing for years and years, the one thing that I hope that you've seen is my consistency, the trading tools, because these are the same. And by the way, I started our talk off today with a look at the CL. We're going to take a look at some futures contracts here today, because I'm going to talk about, this is a trading tool as well. It's what I call my Forex chart. So we're going to go through all these trading tools. So let me just summarize what we're going to talk about here, if for no other reason than to keep me on track as well. So again, I'm Raghee Horner. I've been a futures, stocks, and Forex trader. I've been trading futures for almost, over 20 years. Equities for nearly as long. And I started trading, and I added Forex to the mix in basically late 99, early 2000. And frankly, I wasn't really eager to do that, because I was having a great time trading two futures contracts that were highly anticipated, which were the E-mini S&P 500. And a lot of these electronic mini contracts soon after, I believe in 2001, the NASDAQ 100 futures contract. So, I was a very avid futures trader. And even though I'm known more now for Forex, my roots are futures. And I'm going to talk about how we use some of these charts and what you might see happening in crude oil and the Dow, and how to use that to be a better Forex trader. So the tools that I want to use here on my charts, I'll show you how to get them. Nothing here is going to be proprietary to the point where I can't tell you either where to get them or where to download them. Everything I'm going to share with you, somehow you can get for free. So I'll be sure to let you know where you can get all that. There's nothing here that you have to necessarily pay any kind of subscription for or anything like that. So I wanted you to have these, be able to use these tools. I should also mention I am the chief currency analyst for Interbank FX. It's something I'm very proud of. I've known the people at Interbank FX since my first book was published with Wiley back in 2006. So it's a relationship that I treasure, and I've known those people for a very long time. I've also known the folks at AutoChartist. I am a chief market analyst for AutoChartist. I haven't been doing as much, but I've been an avid user of their tools for years, and I'm going to show you how to get the tools that I use and how I use those as well. So a lot here to talk about. You know, one of the things that, and Mike, that's a great question, Mike, what you kicked off with. So let me address that right away. And that is, Raghee, as you keep learning new things year by year, I've been tempted to add things onto my own system from time to time. Mike, I will tell you, I've tweaked, but the basics of, and that's a fantastic question, because it's interesting, if someone asked me what was the turning point for my saying that, gosh, I could actually do this, I'm pretty good at this, this is something I could do consistently, maybe for the rest of my life, this meaning trading and analyzing the market in a successful way. I'd have to tell you the turning point came, and think about this for a moment, and then we're going to get right into the nitty-gritty of all this. So I've only got the 90 minutes with y'all. So the most important thing, and this might be the most important thing I'm going to tell you guys today, if not ever in my life. Everything's a bell curve. We start off with nothing. You know, we start off knowing nothing. You know, if we were, it's almost like this kind of, it almost looks like this chart of crude oil right now. This is probably a pretty good example of kind of our learning curve. So if you consider the left side of the chart right now, knowing nothing. Okay, we've all been there. Knowing absolutely nothing. And we are ready to sponge up and learn and grab and print out and record everything, right? This is the zero. And when we start doing that, it's like a rocket ship taking off. We hate when the markets are closed on the weekend. I literally used to get depressed Friday afternoon. I hated when the markets closed. I felt lost. It was like this was what I did, what I wanted to do forever and ever. And on the weekends, it was like I was a dragon slayer with no dragons. That's the best way I can put it. And, you know, because every day when you're brand new is a new lesson and a new tool and a new article, and it was just constant, awesome stimulus, right? So everything, right? We start printing out everything. We start trying to get our hands on everything. There's just this huge learning curve. And then all of a sudden, things start to go down, not because necessarily we're losing or anything, but just things start to go down because at some point we realize we've just simply got too much. We reach a threshold and we simply start to say, okay, let's be realistic about this. And we start to whittle away. And we start to whittle away. Maybe we'll add a few new things here and there, but we start to whittle away. Okay, so it's this process of taking all this stuff that we just crammed in our heads and then started to say, well, I really don't like this and I'm not going to use this. Oh, maybe I'll keep this. And then we hit some sort of bottom. And sometimes that bottom comes along with, unfortunately, a lot of losses. You know, we hit this level at which, you know, we reach this area where things aren't necessarily really happy. It's losses. Maybe it's not even losses, but it's overwhelm. And it's doubt, and it's all these things that just kind of depress you, right? From there, after all this whittling away, I think we reach a point at that time we say, okay, there's certain tools I'm going to keep, and we move on. And I guess crude oil could be a pretty good, this crude oil chart could be a pretty good example of kind of what I feel the process is. And for me, the most important thing is the whittling away, is the stripping away of the unnecessary, of the extraneous, of the things that don't make sense, of the things you simply don't like. If anybody here has read the Market Wizards books, I don't know how many people here have read those books, the Market Wizards books. But if you have, okay, cool. So you guys know what I'm talking about. If you have, then you know, and I hope that if you haven't, you'll get curious enough and possibly think about doing it. If you haven't, I would really encourage everybody to head on over to Amazon, and I'm going to actually pull up a few of my favorite books right now that I really encourage y'all to check out. So let me grab this internet browser window. All right, so a couple of my favorite books to check out. Let's head on over to Amazon. How many of you, by the way, out there ordered one of those Kindles, the Kindle Fires? I've got mine. I just was checking the UPS status, and mine is out for delivery. Very excited. I ordered 3 of those babies on the early part of this month, and I am super excited. So if you did order one of those, this might be a cool book to add to it. All right, so a couple of my favorite books. First of all, let us this is one of my favorite books, What I Learned Losing $1 Million. Sometimes it's difficult to get in terms of, and don't overpay for this book. It's a great book. Sometimes you won't find it new. They do new publishings from time to time. Sometimes I think Trader's Library has this. Do a poke around. It shouldn't cost you more than $20 or $30. Awesome book about the process by which we all absorb and deal with a loss. Okay, I did mention the Market Wizards. And the cool thing about this book is it's not about teaching you how to trade. I think a lot of people pick this book up and think, oh, I'm going to learn all the trading secrets of these very successful traders. What you're going to learn is that each one of these books, I don't know how many people he interviews, 20, 30 people? I can't even recall how many people he interviews, but there's quite a few. The first one was probably my favorite. And within the first one, I probably, they're all great. They're all great. Okay. Marty Schwartz was one of my favorites. Ed Seykota was one of my favorites. I mean, it's legend after legend after legend. Okay. But what you'll learn is they all trade differently. Some of these guys are pit traders. Some of them are systems traders. Some of them are back office, discretionary. They all approach the markets in terms of entries in a different way. So this quest we all have for finding that magic way of trading, stop. What you have here, if you've attended these webinars, you get to meet with all these different traders from all walks of life, from all over the planet with different approaches. And what I think is so special about this is you get to find out and sit down and go, okay, which one of these people kind of looks at the market the way I do? Are they wired like I am? And if you can find a person who seems to have a similar view as you, and you see the way they're looking at the markets, and you can use them as a mentor or as a model, then you're well on your way. Okay? Don't simply go after somebody because they're quote-unquote a successful trader. There's plenty of them out there. Find the one that trades in a way that you can also find yourself doing for a while. So it kind of goes back to, you know, as I learn new things, have I been tempted to add things? Well, the one thing that shaped me as a trader, probably more than anything, and we're going to get into this right now. And by the way, I do encourage you all to pick up the Market Wizards. I do encourage you to pick up the new Market Wizards if you like that, although I don't find it to be as good as the first, although Linda Raschke's in it, who I absolutely think is a must-read. So if for no other reason, pick up the new Market Wizards for that. And then there's another one that's pretty interesting that I haven't really sunk my teeth into right yet, but it's called The Heretics of Finance. And it's about primarily technical traders, the heretics of finance. They're all technical traders. So it's kind of like the Market Wizards for technical traders. That's a new one. I haven't quite gotten into it, but it's sitting right in front of me on my bookshelf, and that's another one that I feel is going to be a great read. I've thumbed through it, and I enjoyed what I did thumb through. And then the ultimate book for technical analysis, the one that everybody else has come after, is Richard Schabacher's Technical Analysis and Stock Market Profit. This is the first major book on technical analysis. It's the one that everybody else has read and then went and wrote their own book on technical analysis. In fact, I think Edwards or McGee, one of them, Schabacher was their uncle or something like that. I can't remember the familial relationship, but everybody else has read this and then basically turned out their own version. To me, no one's done it better than Schabacher. He did it first. He did it best. Just my humble opinion. Excellent book to have on your shelf about technical analysis. Don't let the stock market thing throw you. Okay? When you trade as many markets as I do and have, you realize the bottom line is it's just price action, and price action is a tool by which we gauge, we measure sentiment, momentum, and trend. We're going to get into all that. Okay? All right, so I did want to start off with the foundation. This will kind of answer the question that Mike proposed, which again is I think really important. Oh, by the way, Jimmy Wales, the guy who started Wikipedia, was a trader. How cool is that? All right, so if you go Wikipedia, Dow Theory, this is what has shaped me as a trader. And everything fits within the confines of my approach to trading, which is this. All the tools and strategies that you know right now are great. I'm not going to tell you to abandon any of them. I'm not going to tell you that you need to supplant them with what I'm going to teach you. But what I will tell you, and this is probably the second most important thing I'll mention, other than the whittling away process, and I mentioned that whittling away process was where every trader turns the corner. When you find yourself putting on the blinders and you're willing to stop adding new things and you're willing to subtract and whittle down to those tools that you are going to use day in and day out consistently without being tempted by every new shiny thing that catches your peripheral vision, that's when you will make the turn as a trader. When you decide these are my tools, it's not that the other ones aren't any good, but these are the ones for me. Period. Okay? So Dow Theory is I guess you could say the filter by which everything that I use gets run. If it doesn't fit into this idea of my, number one, understand the market movements and market trend. Everything for me starts with the market trend. Because, again, like I said, all of you might have a handful of strategies that you use. And what I would propose you do first is start with asking yourself, of all the different strategies you have, maybe you have a moving average cross thing, or maybe you're an Elliott wave guy, or maybe you have some sort of stochastic thing, or I don't know. I mean, obviously, the number of entry strategies out there are endless. But what I would like you to do is categorize each one of your entry strategies and ask yourself, which one of the market phases do they fit into? So the market phases essentially are a sideways accumulation phase, which is a very low volatility environment where you've got usually a narrow range between the support and resistance. You have typically, if you're a stock or equities trader, it might be low volume. We don't gauge that with Forex. But it's a quiet sideways, some might look at it as a narrow sideways channel, whatever it is. Okay, we have the accumulation phase. Now, there is a strategy that you want to use for accumulation. That's what I'm going to be talking about in terms of how I handle accumulation is going to be a momentum strategy. In other words, since there is no overwhelming momentum, bullish or bearish, prices are essentially neutral, how do I take this accumulation phase and trade it? Again, I'll use a breakout-breakdown strategy, typically consolidation patterns, like triangles, rectangles, pennants. Okay. The next phase we're going to talk about is distribution, which is also a sideways market phase. Distribution is more volatile. There is a wider range between the support and resistance. Oftentimes, I'll fade within a distribution range if it's wide enough using a stochastic. That's one of the strategies we'll talk about. We have trends, obviously, uptrends and downtrends. Okay? So, when do you become a trend follower? Dow Theory applies to every kind of trading you will ever do, because Dow Theory isn't about the stock market, although people associate Dow with obviously equity. It's about psychology. What Charles Dow did that was so brilliant is that he focused on the market's movement and related it back to what kind of participant was being involved and what the psychology was behind that participation. It's all about market psychology, gang. It's less about symbol in the upper left-hand corner of your chart. Okay, it's less about the symbol and more about the psychology that is dominating that time frame. That's what Dow Theory did for me. And from that understanding of the different phases of the market, up and down trends, accumulation, distribution, I realized I'm going to need a strategy to handle narrow sideways markets. I'm going to need a strategy to handle, sorry, I'm getting over a cold, to handle a wider ranging sideways market. I'm going to need a strategy to handle uptrends and downtrends and reversals of those trends. So it's less about necessarily accumulating all these strategies and then just throwing them like spaghetti at a wall, and more about looking at your strategy and categorizing it into which one of these market phases they are the most suited to handle. Does that make sense to everybody? You match your strategy to the market. You don't impose your will on the market. Unless you are writing checks and the bank bounces, you cannot, and even then, you cannot impose your will on the strategy, your will on the market, regardless of the strategy. Even if you're a central bank and you can print money till you run out of ink, they can't even impose their will on the market, right? Exactly. The market's the boss. So everything starts from Dow Theory and understanding those market trends. How do I define the market trend? Okay. So if you haven't got a pen and paper out yet, now might be a good time, because I'm going to start, we're coming into, now that you know, we spent a little bit here discussing the overall philosophy. And I know a lot of people just kind of glaze over during this point. Bad idea, because that is what I've just explained to you is the rationale behind why I do what I do. And unless you understand the why, the first time you start to get confused or have doubts, you won't have the foundation to rely on to say, okay, am I really working within the confines of my main goal here, which is to identify the market trend and therefore, after that, apply the appropriate strategy according to the message of the market. That's what it's all about. How do you identify the message of the market? That's what we want to discuss at this point. How do you identify the message of the market? The message of the market is the market trend. Now, each time frame might have a different message. In other words, it might have a slightly different trend. Okay? We're going to get into that when I discuss triage, but the first thing I want you to do is understand, and this is basic stuff here, gang, but the basics are what your success is built upon. You notice that I've got a daily chart of the dollar index here in front of me, and I did mention how important futures are to me. I'll look at the dollar. We had crude oil up earlier. I'll look at the Dow Jones Industrial Average. I'll look at the continuous commodity index. I trade Dow futures, the YM contract. I have some trades going on in the ES contract, the S&P 500. So these are charts that are throwbacks to my roots as a futures trader, but they all have a lot of implication in terms of what's happening in Forex. Very important, because the Dow, the dollar, crude oil, commodities, you can throw gold in there too, but not as much as it used to be. You can throw copper in there. There's been a lot of talk about WTI and crude because of the contango. I don't want to get too far off my topic. Some of this stuff we'll discuss in the second half. But these are all ways to gauge risk. Gang, what we are doing every morning as Forex traders, the first question on your mind should be, is risk on or off? Is there risk appetite out there? Are traders and investors' stomachs grumbling from some risk? Or are they just stepping away from the table? Risk aversion. That is the first question. How do I answer that question? I look at the dollar. I look at the Dow. I look at the trends. Now, just as I would look at the market trends, market phases on my Forex, I do the same thing on these charts because one, I trade them, and two, they're going to give me insight into what's happening in the Forex market on that bigger picture. And that's going to allow me to better trade the pairs that I trade. So let's get into specific time frames here. You notice that I've been looking at the daily time frames, or if you didn't notice, these are daily time frames. And let's jump on over to some Forex charts. So I'm looking at some daily time frames here. And the reason I want to start with the daily, and we're going to go through all the time frames that I look at and how I look at them, but the reason I start with the daily is to be able to identify what I call the directional bias of the market. The directional bias. I think the daily time frame is the most psychologically significant and reflects the overall dominant psychology of the market. That doesn't mean that I'm trading it necessarily. It means that I'm using it as a gauge to understand the mood of the market. And actually, one of the things that I was looking at, and I wrote about it yesterday over at the Daily Forex Trading Edge, which is a blog that I write for the folks at Interbank FX. And I'm trying to remember the pattern that I'd drawn in. I believe it was in a rising, there we go, there it is. It's a rising wedge. Now, I wrote about this particular pair. But the reason I want to start with the daily time frame is to get a gauge of what the directional bias is, which is there a dominant bullish or bearish psychology on the daily chart? Think about this for a moment here, gang. If there is a dominant psychology in the market, I don't care if it's equities, futures, or Forex, if there's a dominant psychology, when prices start to sell off, people will be more willing to step in and support certain price levels in the bigger picture. So in an uptrend, people will tend to look for opportunities to be a buyer. And in a downtrend, even a great up day will often be shorted into. So you have to understand the dominant psychology because it'll give you an idea of what people will tend to do depending upon price action. The directional bias for me also sheds light on which time frames I will focus on. So when I have a non-trending directional bias, like I do here on the dollar Canada, which I define it as non-trending because take a look at the angle of the wave. It's moving sideways. By the way, for those of you who don't know what the wave is, it's the 34-period EMA on the high, the low, the close. Those are these dashed lines you see going across my chart. The other lines on my chart here are the 20-period simple and the 200-period simple. The candle colors you see here are a little different than your traditional Japanese candlesticks because I kind of call these candlesticks plus. They're grab candles, green, red, and blue. And in addition to my 34 EMA wave, in addition to my 20-period simple on the close and my 200-period simple on the close, these grab candles are ways, a tool in which I can determine the way in which prices are moving in a bullish or bearish manner. The way they plot is if we close above the 34 EMA high, the candles plot green. If they close below the 34 EMA low, they plot red. And if they close within those two lines, it plots blue or neutral. You can get this indicator, you can get this plugin one of two ways. Excuse me. So the first way you can get it is I have a blog at RagheeHorner.com. And if it pops up, well, that's one place. Let me go to the other place you can get it from. Now, the difference between the two, if you go to my personal blog, if you look in the right-hand corner, there's a search box. You can see that right below the CNN Money Partner logo, the search box there. Do a search for GRAB 2.0. And what you'll get is a tutorial as well as the newly updated plugin. And if you're not used to, and they only run on MT4, by the way, gang. It's an MT4 plugin. So you're basically going to unzip or expand the files using WinRAR, which is a free program, and then you're going to stuff those indicators, just 3 separate indicators, into your indicators folder. So if you're comfortable installing your own indicators, great. It's not a self-installer. It's just a zipped file with the 3 tools that make up the graph. Okay, that's one way of doing it. And this package from my blog will work on any version of MT4. Okay? The other version is from Interbank FX. Okay? And if you go to their website, and again, all my cards on the table, I am the chief currency analyst for Interbank FX, and I have an account with them, I trade through them. Obviously, I do my daily Forex trading edge with them. If you have their platform, demo or live, it is built in as a set of custom indicators as well as a template. Okay, so it's built into their version of the MT4 platform. Interbank FX is actually located here in the U.S., in Salt Lake City, Utah. And actually, as of yesterday, and I don't know if many of you got the news, as of yesterday, they were purchased by TradeStation. So they were just purchased by TradeStation. So some big changes for Interbank. And I do want to mention, I do weekly webinars with Interbank. So you can free weekly webinars that I do with them actually, not every, but I think 2 or 3 times a month. And you can get that schedule over at the Daily Forex Trading Edge. If you go to that website, this is where you'll find some of my commentary, and then the schedule for the webinars as well as replays of my past webinars are available at the education. It's a free sign up, and tonight I'm going to be talking about support and resistance, advanced support and resistance. Okay? All right. So having said all that, that's where you can get the plugins from, either from my website or from the Interbank FX platform. All right, sorry about the coughing, gang. I just had this nasty head cold that I'm just now getting over. I know I sound pretty horrible. All right. So those are the tools that are running on this chart. And I'm going to use the 34 EMA wave I'm going to use this 34 EMA wave to gauge that, again, that Dow Theory inspired market trend or market phase. So how do I use the daily chart to determine which time frames I'm then going to focus on? That's the triage process. I don't know how many of you focus on one time frame and only that time frame. I don't know how many of you scan through different time frames. I'm a scanner. I scan through multiple time frames. I have a specific strategy for the 5-minute. I call that the between the greens. I would recommend, if you want to learn more about that, I'll probably be talking about it in the second half, but you can also check out my YouTube channel at youtube.com/Raghee Horner, as well as Interbank FX's YouTube channel. It's youtube.com/Interbank FX videos. So I have Between the Greens educational lessons at both those channels at YouTube. So that is exclusive to the 5-minute. But the 15, the 30, the 60, 240, those 4 intraday time frames, I triage or I sort, I prioritize to find out which is giving me the most market clarity. So a lot of you might say, well, Raghee, it's kind of hard to go choose, find a trade to begin with and then start looking at multiple time frames. I haven't got the time. I get it. A lot of people will be overwhelmed looking at so many different time frames, but that's what the daily chart's directional bias comes in to really help you choose which is the one that you want to focus on. If there is no dominant bullish or bearish trend on the daily, notice the dollar Canada right now. There is not a dominant trend right now. Okay, no dominant trend here. How about, let's just go through the pairs here right now as we go through. The euro, we're just starting to really clarify a bearish trend. I know that might sound funny because I don't consider this to be the established downtrend. There's a lot of bearish sentiment and momentum, as can be seen by my red grab candle, but the wave really hasn't taken on an established 4 to 6 o'clock angle. Not yet. Okay? Not yet. So I can see the culmination of bearishness could drag that wave down to a 4 to 6 o'clock angle, but we're not there. So I don't see a dominant psychology in terms of a trend, but certainly sentiment and momentum. And that's a big difference, because if I don't have the trend, there's no dominant directional bias here yet. Okay, let's go to another pair. How about the cable? Here's another pair that did have, take a look here. This is a shift we're just seeing right now. Nice 12 to 2 o'clock angle on the 34 EMA wave. We had green grab candles that started getting mixed up with blue grab candles. What happened? Bullish sentiment, bullish momentum, uptrend confirmed by the wave. In comes the blue grab candles. In comes the neutrality, right? A little bit more neutral. Okay? In comes the red grab candles, going a little bit more bearish. When I have those red grab candles coming in, the sentiment and momentum then have shifted to a bearish psychology, but that does not necessarily make for a daily chart downtrend. It's the daily we're focused in on here, gang. Not looking at an intraday time frame. When someone says, oh, the cable's trending, if they don't accompany that statement with a time frame, that is a meaningless statement. Okay, if someone says a particular market is trending, again, unless they are talking about the time frame specifically, It is a meaningless statement. So refrain, be aware of being vague about even your internal dialogue. All right? So again, we're focusing on the daily here because we want to focus on the dominant psychology. How about the SWSD? So what's happening here in the SWSD? Well, I've got the green grab candles indicating the bullish sentiment and momentum, but I still haven't really transitioned into a steady 12 to 2 o'clock uptrend quite yet. Now, we did have one, much like on the cable, we did have the 12 to 2 o'clock uptrend as seen here on the wave, but then it transitioned. The angle of the wave flattened out. We can see the blue grab candles coming in. We can see the red grab candles coming in. So now we're kind of actually looking at what could be a very wide sideways range on this pair, but no dominant bullish or bearish psychology in terms of a trend. Yes, we do have momentum and sentiment indicating bullishness, but not a bullish trend, not at this moment in time. Okay? So you can see I'm just kind of going through each one of the pairs, trying to make these determinations about what that dominant trend is. Now, here's where you use this information and then you can make a judgment call in terms of how you're going to trade intraday. And here's how this works. If there is no dominant trend on the daily, like what we have here on the Canada, there is no dominant bullish or bearish trend, my recommendation then is to focus on the short-term time frames. You can go to a 5-minute between the greens, which is a big part of what I do this time of year. And after about Halloween, I start to focus on short-term time frames, very short, because I'm in and out of the office a lot. Family starts coming into town. I really start wrapping up my year. You know, I don't want to do a lot of trading into the holiday season. And also right now, with the shifts in sentiment coming so violently and so quickly, there isn't a lot of longer-term follow-through, is there? And the reason I know that is because the daily time frames are not indicating a trend. If there was longer-term organization, momentum, and sentiment, we'd have trends, but we don't. A trend is made up of the organization of sentiment and momentum. So when I don't have the organization, I don't know that I want to rely on longer term time frames to follow through. So therefore, I will focus on the short term. When that daily time frame is lacking some sort of trend, like we saw on just about every one of the pairs we just looked at, that's when I want to focus on short term. So 5 is one of them. But again, very specific strategy between the greens, and you can check that out on the YouTube channel. And like I said, I'll probably talk about that in the next, in part 2. But the 15 and the 30 become really most of my focus. They're intraday time frames. I can get decent setups on them, but I won't need that longer-term organization of sentiment and momentum. I won't put myself in the same type of position of expecting organization on a longer-term time frame like a 60 or most definitely a 240. So when there is not a clear bullish or bearish directional bias, focus on the short term. I think right now that's been the wiser way to go anyways based upon the volatility in this market. So triage is the process of looking at the overall market's psychology via the daily and then fine-tuning where you have obviously the best chance for follow-through, but also where you have the best clarity. Now let's talk about clarity for a moment. That's where I focus in on the wave and the grab candles. So clarity comes from understanding how smooth. Let's jump over to another pair, and if there's a particular pair you guys want to look at, just let me know. But the clarity comes from understanding, number one, which time frames you should focus in on. But number two, you want to be able to then look at the wave and ask yourself, okay, do I have a smooth set of EMAs on my wave? Are the moving averages smooth? I then want to ask myself, in addition to that, are they established? Have they been moving at that particular clock angle, 12 to 2 or 4 to 6 or flat at 3 or more wider ranging at 2 to 4? Have they been moving at that clock angle for some time? Are they established? And then in the case of a trend, the 12 to 2 or the 4 to 6, you then ask yourself, has there been respect for the resistance of the wave on this time frame? So on corrections, has the wave been able to manage containing price action? In a downtrend, has it been dynamic resistance? In an uptrend, has it been dynamic support? Those are the criteria for the wave. Here's a downtrend, the current downtrend on the cable, which happens to be, and how do I notice that the downtrend is doing more than simply correcting? That's the difference between the last couple bounces, which were short. There's a number of swing shorts on this chart, right here and right here. I define a swing shorting opportunity by, number one, we got to find the overall trend, identify that, if it's bullish or bearish. Then if we do have a downtrend, I need to define what a correction is going to be. This moving average angle is 4 to 6, which gives me that downtrend, and that means bounces can be shorted into, but not just any old bounce, preferably a bounce into the wave. Now there's actually an area that I watch that I call my swing zone. The swing zone is made up of the 20-period simple, one of the indicators that I told you earlier that I use, and the 34-period, in this case, 34-period EMA low. So the swing zone, in a downtrend, you must have a downtrend first. So once you define that trend by, look what's happened here. We have this steady flow of red grab candles. So organized sentiment and momentum pushing us lower and then pulling the wave down into a 4 to 6 o'clock clock angle. At that point, I've got these bounces that are occurring into this area between the 20-period simple and the 34-period EMA low. And these are opportunities to trigger one of two kinds of shorts. One is the aggro short. This would be an aggro right there because it hit the 20-period symbol. This would be the conservative, which hit the 34 EMA low. Again, here's an opportunity for the 20-period simple, and then it hit the 34 EMA low. This one just hit the 20-period simple. This fourth bounce hit both. You can see these smaller corrections, like this one right here, didn't hit anything. So there's nothing to be done, for example, on this move right here. There's nothing to be done. We didn't hit any of the levels. All right, so of the 4 times, 1, 2, 3, 4, of the 4 times, actually 5, let's see, 1, 2, 3, 4, 5, of the 5 times that we bounced. And by the way, when you're trend following, at some point you're going to get stopped out. Obviously, no trend goes on forever. At some point you're going to get stopped out. So we had this nice 4 to 6 o'clock downtrend. We entered the area between the 20-period simple. And by the way, why do I differentiate between aggro, aggressive, and conservative? It has to do with position sizing. At the aggro levels, I'll put on typically no more than 1/3 and as little as 1/4 of my overall position size. So let's say you trade with 4 lots. You'll put maybe 1 lot on. And if you trade with micros, you can break that 1 lot into even less. Okay? At the conservative level, then I'll put the remainder of the position on. So at the aggro level, I'm just engaging the market. I'm making sure I've got some skin in the game, but I'm not putting in my overall position size. That's why it's an aggro level. It's a shallower correction, but I don't want to pile everything in at that level. Okay? So those were my entries. Now, this last one didn't follow through. The wave started to lose its angle as we started seeing more blue grab candles coming, and now we've gone green, and any of my open swing shorts based upon this time frame and these entries should be out, because the validity for the trade is based upon the 4 to 6 o'clock clock angle and the fact that the wave acts as pressure, selling pressure on each bounce. Again, that dynamic resistance, and we've lost that now. There's no more dynamic resistance. We've gone green on the grab candles, so now we're looking at bullish sentiment and momentum, and we've broken the wave. Actually, we did that back here. Okay? So no more swing shorts. The wave angle is gone, and the sentiment has shifted. But in the meanwhile, 1, 2, 3, 4, 5, 6 short entries. Yes, the last one ended up being eventually stopped out. You know, this is where it's no longer valid. But it was a ride down from basically just above 5,900. Okay? Different opportunities. In the case of swing trades, because I do have a defined entry, because I do have a value for the 20-period simple and the 34 EMA low, it'll slightly change every hour. This is a 1-hour chart. But because I do have a value, I will park an order. In other words, I will use a limit order. I call it parking an order. I can park my order. And now in this age of all these wireless devices, I can access my VPN from my iPad. I can access my actual desktop from my iPad. So I can adjust those entry levels even when I'm not in the office. But the initial heavy lifting, identifying the trade and setting it up, is typically done in my trading office. But then at that point, especially after noon Eastern Standard Time, when I'm pretty much done with my day, and I decide I need to, walk away from the midday doldrums, I can still, at lunchtime or wherever it is that I am, I can see my positions. I can still manage them if need be via my iPad and my iPhone if I have to. But the iPad's great for that. In fact, a lot of times I'll just shove my MacBook, with the Air being so small, it's almost like an overgrown iPad. I'll just shove that into my purse. But the reason the iPad is so nice, or any kind of device that comes with its own internet connection, doesn't have to be a Mac product. I'm just telling you what I have. But anything that has its own internet, I would love to be able to carry around my laptop everywhere. That the MacBook Air was actually a gift from my best friend for my 40th birthday. I love that thing. But because either I have to have my own internet with me, in other words, have some sort of modem card and all that kind of stuff, or be in an area with Wi-Fi, sometimes I don't want to be troubled by all that, although it is a better option as compared to the iPad. But, mobility is a big part of being a trader nowadays. We have that ability, and I can't stress enough. For me, trading is a lifestyle enabler. It's a lifestyle enabler where I don't want to be in front of my computers all day long. I don't want to be here in my office trading for more than 4 or 5 hours. I might come back and write, but I love to write, and I can write from anywhere, and I often do. But as far as the trading goes, I don't want to be here 12 hours a day. I don't want to or more. I love to trade, but I know that my focus and my attention and so forth, I'm good for about 4 or 5 hours. I'm very sharp, and I can do what I got to do for about 4 or 5 hours. And for those traders that are getting diminishing returns, I ask them, the first thing to check is, how long are you in front of that darn computer? Because as traders, we are not in an employee world. The paradigm is not one of an employee, and a lot of traders have that difficult time getting out of that clocking in and clocking out mentality whereby they think time put in equates into success. Obviously, you need to put the time in at some point to learn your trade, to learn your craft, I should say, and understand the tools you're using. But at some point, more time is not better. I think focus time is better, and I know for me, my focus time is about 4 or 5 hours. Now, I've got some buddies who are scalpers who will trade 50, 60, 100 times a day or so forth. And one of the things that I will tell you is they have an incredible amount of endurance. They can be in front of the computer 8, 10, 12 hours. I simply can't do that. I simply cannot do that. So what I like to do, and my professional life is kind of divided into two things. What I like to do is get up in the morning and enjoy the quiet hours in my house, where I could look at the markets and trade until about noon. And then I'll go have lunch with a friend, or I'll go train, or I'll go to the gym, I'll go play golf, whatever it is. I'll go do that in the afternoon. But those 4 or 5 hours are mine to trade. It's me and my charts. And I love doing that. In the afternoon, I get to do the other thing that I love to do. And that is I get to write and record videos and maybe make phone calls and teach a little bit. I don't teach as much as I used to. I do a whole lot more in terms of writing and analysis and videos, which I guess is kind of like teaching, but I don't do the teaching thing as much anymore. To be quite frank, it's just not as enjoyable for me. But what's cool is I do have these two separate professional lives, and I completely respect teachers, but it's exhausting. I won't kid you. It's exhausting. But I'll tell you, because I do have these two separate lives, I get to really do two different things every day, which is nice, and I get compensated for both, so that's even better. Now, I mention it to you guys because I do want you guys to have two separate types of what I call a productive or creative distraction. This is really important, gang. I don't tell you what I do during the day to brag. I tell you because I'd like you to have some sort of version of it for yourself. Focusing on the charts and on the markets all day long is not productive. It's just not. Most of the time, most traders will not have the type of endurance to go that long. So you need ways to kind of still stay engaged with the market. I get that because you guys love it. I will tell you all, go blog. Go start a YouTube video channel. Write an article. Everybody here in the room, I will tell you right now, I offer this to everybody. Because 20 years ago, somebody offered it to me, and basically even before the Internet was the Internet, but even in the Internet's infancy, one of the first places, by the way, years and years and years ago, I stopped doing it, but I blogged for FX Street back when they were a much, much, much smaller site. I'm trying to remember. I went to archive.org to look it up, but it was a long time ago. And, there's certain sites where they said, hey, you got commentary? We like it. Yeah, we'll post it. I'll tell you, everybody here in the room right now, if there's an article that you've written and you think you've just really put some good ideas into it and you want to share it, let me know. I will post it at one of the many, many places that I write. And maybe, hey, at some point, on top of your trading, maybe even you'll have a secondary, more fun kind of hobby income coming from being an analyst or a writer, a financial writer. It's a lot of fun. I pinch myself, but it's because someone gave me a shot. And I tell everybody here in the room, if it's an article you think is really good, I'll read it over. And if I think it's good too, I'll post it at one of my sites. Because I think there's a lot to be said about different viewpoints in the market. It doesn't have to be agreeing with mine. Okay? So let's get back to the swing trade here and talk about validity. I mentioned here on the hard right edge, it's no longer valid. It's no longer valid for a couple reasons. One, we've lost that 4 to 6 o'clock angle in the wave. But two, we've also broken through the wave. So the stop loss for a swing trade, the stop loss for this trend following trade. By the way, remember I said categorize all your trades? A swing trade is a trend following trade for me. Okay? So what you want to do is define where an entry is no longer valid. And if my validity is based upon the dynamic resistance of this wave, when it is no longer acting as that, it's no longer a valid trade on this time frame. So what I want to do is place my stop just above, in this case, the 34 EMA high, and add about 3 to 5 pips, because it's also resistance. I don't want to put my stop right at resistance. I want to put it just beyond resistance, and that is my stop. And by the way, you can trail it all the way down. Now, there's 3 kinds of stops out there, gang. The point of validity stop is your risk-based stop. That's the stop that you would use that if hit upon the initial entry, that's the stop at which you would recognize a loss because the trade never went in your favor. It's a risk-based stop. It would represent a loss of capital. The second stop we love to transition to, once we've hit our first profit target, is at break even. And I'll usually place that about 3 to 5 pips in this case because they're shorts above my entry. The last stop, and that's the one we all want to get to, is the trailing stop. The one that even if hit would represent a small profit as we see the trade move in our favor. So we want to transition from that risk-based to the break-even to the trailing in a manner that reflects the trade moving in our favor, and the confirmation of that is reaching the initial profit target. Okay? So that's a very important consideration. You have to define an initial profit target because that's where your risk management transition comes in. All right? So in this case, again, swing trading into the wave. Actually, it's that area between the 20-period simple and the wave. Here, stopped out, and no longer valid. I know I saw a request for the euro. So let's go take a look at that. So far, again, when I want to talk, make sure we talked about the trading tools, talked about the scanning process. Prioritization comes from understanding the dominant psychology, so I can prioritize time frames based upon how clear or not clear the trend there is on the daily. So we can focus on near term versus, say, short term versus long term views of the market. And then everything is based upon those market trends or market cycles or market phases, whatever you want to call it. I believe Charles Dow calls them phases. Everything is based on that. Notice I just didn't pull swing trading out from under my hat because I wanted to. I did this strategy based upon the market phase. Okay? The grab candles and the wave help me confirm trend, which is made up of organized sentiment and momentum, and ultimately reveals the market's psychology to me. Okay? So that's what we've covered so far. So let's take a look at a few more examples to start getting into some of the pairs that you guys have requested. Euro was a pair that was requested. Okay, I see that there. All right, so the first thing I want to do is go to what? The daily, right? And from the daily, I will determine what the directional bias is. And while there is an overwhelming amount of negative, bearish sentiment and momentum, we notice that there really has not begun a downtrend on this time frame. We had one back here. We had a small uptrend here, and now we're into just basically a very wide, well, I won't call this a wide range. I think that if we continue to press lower, we'll probably complete the transition into a downtrend, but the daily chart does not give me a dominant trend. Yes, I have direction. In terms of, right now we're moving down lower, but we don't have a trend. I have bearish sentiment and momentum, but no confirmation of a trend yet. Okay, the wave is still more sideways. What this is going to do is drive me to the 15 and the 30 primarily. I do make exceptions for the 60, but it's got to be a really great set of clarity readings. Again, focusing on the smoothness of the wave, focusing on how long that wave has been moving in that direction, that established question, and then if it is a trend, if that wave was respected. So if I mark very, very high on those readings for the 1 hour chart, better than the 15 or 30, then I'll make exceptions for the 60, but for the most part, focusing on the short term means between the greens for the 5 and then going to the 15 and 30 for that near term or short term view of the market. So I lack directional bias, but we can definitely see there is bearish momentum and sentiment on that euro US dollar. Okay, so now what? Well, looking at the fifth, and sometimes you're going to do triage and realize there's just not a darn thing to do. And that's a good thing as well. Knowing when not to do anything is very powerful. So as of right now, I don't see a lot of clarity on the 15 and 30-minute charts. If anything, it's more of an aggressive type environment where I think traders are going to fade the past exhaustion levels. That's my take on what I see right now. I think that we're kind of in an environment where traders will look at overbought and oversold, that they're looking at range, intraday range of this pair, and that if you lay up a stochastic, you could probably execute distribution fades in this environment. But let me add to that this is a very aggressive type of trading. When we don't have a direction, when there is not a dominant psychology, and traders can't look at the chart and say, yeah, we see the uptrend or downtrend dominating the market, what happens is that doubt, that lack of organization, that lack of a concerted opinion turns into exhaustion. And that's what we've seen for the past couple days. That once we get to an area that starts to get a little toppy, and I confirm the toppiness with a stochastic, a great oscillator for this environment. Again, I'm not pulling out the strategy because this is simply what I want to do. I'm pulling out the strategy because that is what the market is telling me the psychology is. It's right now on this environment, on this time frame, it's an environment of exhaustion. It's an environment where overbought and oversold seems to be faded. Okay. So that's what I see here on the 30. I think the same can be said about the 15. Now, in terms of the 60, it's the same type of sideways environment. I can fade the 30 or 15. I don't need the 60. The 4-hour chart. Here's where, again, because I don't have a clear trend on that daily time frame, I hesitate to get involved in the 4-hour because I don't know that we're going to see the organization of sentiment and momentum offering me to follow through on this longer time frame. But here's where understanding the overlap can help. A lot of you might say, well, Raghee, can't we swing trade this? This looks like it's heading down lower and there's exhaustion maybe coming at the wave. Well, two things. The lines are smooth enough. I don't argue that. But they're not established and there hasn't been a lot of respect for the dynamic resistance of the wave. But let me add, what would be the entry here if we were going to take it? It would be a short, right? We'd be shorting into resistance. Well, isn't that exactly what the 30 or 15-minute fade would be? Shorting into resistance. So in essence, if we wanted to swing trade the 240 with the expectation of a push lower, isn't that exactly what we're looking at in terms of the distribution fade on the 15 or 30? Again, looking at that overbought, looking at that resistance and shorting into it. That's exactly what it is. But this is always an aggro setup, and the trigger can be, we see 3 lines here. The aggressive trigger could be this lowest line here. And basically, I'm drawing these lines based upon past resistance. Okay, all these lines are based upon past resistance. So I could engage the market in a short right now, at this point, again at this middle level, and again also at this top level. The top level and the highest high within the range is important. because above that top level by about 10 to 12 pips is going to be my stop loss. So whatever that level is, just above it is where I want to place my stop loss. So that is the importance of understanding the range and then also defining where the trade is no longer valid. And for me, yeah, we could keep walking ourselves higher and higher and higher. I don't want to do that. I'm looking at the range of about the last 2 days. That's why I walked myself clear up to these highs as well. But at some point, we need to make a decision about how long we're going to hang on to one of these trades. I kind of like this 35.57 area or this 35.50 area. Its high was actually 35.56. And the reason I like that is I get to use the major psychological level at 50. And if there is an explosion higher, an acceleration higher past that level, I probably want to step out. Okay, because my rationale is for exhaustion in this pocket. And if I don't see that happening, or I should say these layers, okay, I probably don't want to take it. Now, here's the challenge. If you take the trade way down here, your risk is higher because my stop loss is way up there. Now, if you want to place a 10 to 12 pip stop above every one of these levels, you're certainly entitled to do that, rather than sit through this entire range. Okay, that's absolutely a valid point. The range I have here is basically between 35.39 and 35.57. So it's not a huge range, okay? But huge is going to be defined by what you're comfortable with. So if you're uncomfortable taking the heat between 35.39, call it 35.40, and say 35.60, but 20 pips, okay, in this area here. If you're uncomfortable with that, that's fine. But I think 20 pips is a pretty manageable amount of movement for a time frame like the 15. So I would want to short in this area, these layers, and then what am I trying to do? Well, I definitely don't want to be thinking short down in this area because this is where the support kicks in. I'm not saying that we're going to go from one extreme to the other, but in this area is my opinion for prices becoming overbought. What's nice is we actually nail this area just as we were talking about this setup. This is a distribution fade. And the way I, again, confirm it is using that stochastic. And I use a pretty slow stochastic setting, as you can see. At 21 period. And when it's above the 80 level, and I've hit a layer of resistance, that's your short trigger. The layer of resistance comes first. Price comes first. The confirmation of price as resistance and possibly being overbought comes second, and that comes with the stochastic. And that's how I would set that up. That's the euro. And I would stay short term, and I would probably just fade this range. Right? I have a request for the Aussie. Let's head on over there. All the stochastic settings, there's no slow versus fast on the MT4 platform. So I'm sure if you went to one of the code bases, you could download a slow stochastic. I prefer the slow stochastic. And I hope you see how easy it is to notice the sentiment and momentum when you've got the grab candles. You know, determining that becomes pretty straightforward. But I don't have the trend. So what does that mean? Again, focus shifts to short term. If you want to trade the 5 between the greens, but really, again, unless you want to do between the greens, 15 and 30, and start to look for the clarity on those time frames, if there is any at all. And this Aussie is actually looking a lot like the euro in terms of short-term fades. I don't see one thing the euro had that was really nice though was a lot of good horizontal past support versus what we're kind of getting here, which is more of a dynamic situation. I don't really like that at all. So I would not set up a fade on this time frame because I don't feel the levels are as static as what we just saw on the euro US dollar. Not at all. And, you know, we could have resistance kicking in. You know, if you did want to set it up, we could have resistance kicking in here. We have resistance kicking in here, all the way up to this area here. And again, you pull up that stochastic and get rid of these trend lines here. So what's the range between the lowest level and the highest level? I've got a 1.0097 all the way up to 1. Okay, so it's getting about a 20 pip range. About a 20 pip range here again. But going back, you know, the euro had a really nice set of levels that I think gave me more confidence in those horizontal levels that I had drawn. But this is, again, a very low risk position again. You insert the stochastics. And, you know, wait for prices to be hit. And then if they're hit and we have an over 80 reading, we have an overbought accompanying the resistance. And again, this is valid because, one, we don't have that dominant trend on the daily time frame, and two, the wave is also moving in that sideways kind of 2 to 4 o'clock angle, indicating no clarity in terms of a trend. And when there is no clarity in terms of a trend, highs and lows just tend to be faded. People don't have a lot of opinion to carry a market higher or lower, but keep it in a range. And we're just fading the extremes of the range as momentum carries it higher or lower to, again, resistance or support. Okay? Okay, so let's see. We talked about where to get the indicators. Again, I hope you consider Dow Theory in terms of how you select your strategy and your tools, by the way. Your strategy and your tools. Okay? In terms of that scanning process, again, let that daily chart help you determine which time frames have the best likelihood for follow-through, and then also utilize the time frames in such a way where you can allow them to offer you the best look at psychology in terms of that slice of, well, really each time frame is a slice of psychology, isn't it? And sometimes the shorter term time frames just offer you more clarity than the longer terms. And sometimes, as we've seen here, none of them are offering a lot of clarity, and therefore we use a strategy that capitalizes on that lack of clarity. Okay? All right, so let's see. Cable? Sure. All right, so again, starting with the daily time frame. And then from there, look for the organization. And, you know, I tell you, it's still another one of those situations where we're not quite in a downtrend, but you can see if we keep pressing lower, we could see it. What's interesting here, and it's frustrating, but I'm not going to put myself in a position to require longer-term sentiment and momentum. You could probably set up a fade on the 30 based upon some of the past resistance levels. But what's interesting is the best clarity tends to be coming from the 240 right now. The trend is established. The wave is clear. We really haven't had a lot of tests on it, though. So here's what's interesting. As we get up towards this past high, which is the same high you'd fade on the 30-minute time frame, we're also coming into a situation where arguably we could look at a swing short on this time frame right here. So it's going to be an overlap between two setups, a fade on the 30 based upon prior resistance, and that fade lining up with a swing short on the 240. Again, the swing short is not on the 240 is not something I want to necessarily have to focus on because we don't have the clarity on the daily chart. We don't have that directional bias, bullish or bearish, but it's another situation where we're getting overlapped in where resistance could kick in. One within the context of a downtrend as a swing trade, and one within the context of a fade on this sideways volatile market. Okay? You know, if given the chance, I do like to trend follow. If nothing else, I do like to trend follow. That's probably my preferred way of trading. Fades are always aggro. You could get 2 or 3 10 to 12 pip stops before you get your follow through. I do like trend following. I do like, my preferred environment is when the daily charts have a trend. So if you look back on the chart, the chart of the daily throughout this year, and look for those times when we had the 12 to 2 o'clock or 4 to 6 o'clock wave, there were quite a few periods of time throughout the year where we had the clarity, and it was excellent. It was an excellent environment for swing trading when the intraday time frames also yielded a trend. Okay, I do want to mention that our talk is split up into 2 halves today. We have part 1, which is 90 minutes, and I did want to give myself about a 5 to 7 minute break so I can go take some cough medicine. And we're going to start, the next session starts up in about 5 minutes here, gang. So I can take a couple of questions and then we're going to have to wrap it up. But I do want to mention on Mondays and Wednesdays, I do have a chat here at FX Street at 9 a.m. Oh, the next one's at the top of the hour? Okay. So I know this session goes for 90 minutes. All right, so then I also have that session that I do for Interbank FX on Thursdays, and you can check out that schedule over at the Daily Forex Trading Edge. Okay. All right, so in terms of, again, if you look back, the trending nature from time to time of this market has yielded some really good opportunities for me. You know, if I had my way, I would tell everybody, when there is not a trend on the daily time frame, go short term or stay flat. Really, go short term or go home when there is not a dominant trend on the daily chart. I think if you go back, depending upon the type of trader you are, especially if you're a trend follower, intraday or end of day, when you find the wave flattening out on the daily, I think more traders have been whipped up and slopped up based upon not being able to adjust for these very small and quick transitions in trend. You know, this year, let me mention, this year as a trader has probably been one of the most difficult for me, especially the second half of the year. And I'm talking about trading through the advent of small order execution, trading through an adjustment from paper-based charts that I used to update by hand and use a telephone to get quotes to an internet, to true direct access. You know, so I've seen a lot of, in the last 20 years, I've seen a lot of the changes, if not most of them, as a trader through stocks, equities, and futures. And through all those adjustments, it was always relying on the psychology and the clarity of that psychology. And even though I had different technology, it was really a situation where I had to trust price. But this year, again, with all those changes in technology and access and so forth, and even in market, I really have to say 2011 has been one of the most difficult for me personally as a trader, for sure. Just because the sentiment switches so quickly, we're dealing with so many historical issues, you know, especially the second half of this year, dealing with the historical nature of the debt crisis here in the U.S., Europe. Very interesting and difficult times to trade, for sure. As far as the idea of, you know, no trend on the daily, then go home, again, your other option is definitely going short term, 5 minute, 15, 30, staying nimble, so you're not reliant on that longer term organization of sentiment and momentum. That's my advice anyway. One of the tools that I have running on here, by the way, and I'm glad you brought it up, Paul, I do have the power stats running here. Now, I have some video, actually, that I did for the webinar this week, right here at FX Street. I have some video at my YouTube channel on power stats specifically. I can already start to feel my voice starting to fade. The two most recent uploads that I had, and I talk about it there, but one of the things I like about power stats, and it's just another way of looking at support and resistance based on volatility and time, is that it's a unique way of looking at where decision levels might be based upon the mannerisms on the market and the volatility. So I like to add that to my analysis. I like to also add the chart patterns to my analysis, and that's what AutoChartist does for me. It's just alternate ways of identifying support and resistance. One based upon chart patterns. They also have Fibonacci patterns. They just released their key levels, which is their horizontal support and resistance. The way that I use the AutoChartist here, and by the way, you can get this through a number of their partner brokers. This is the MT4 platform as offered by Interbank FX. Now, there are a number of MT4 platforms. AutoChartist is partnered with a number of them. If you go to their website, autochartist.com, you can see their partners. It's just a who's who of Forex brokers, and you can see who their partners are. And if you are a client of one of those partners, the AutoChartist tools are then part of your benefits of being a client. For example, as an IBFX client, I get the power stats and the chart patterns and the key levels, and again, I don't have to pay for them, which is nice. For those of you again that are interested in getting the grab candles, you can do it at one or two places. You're going to go directly to my blog at RagheeHorner.com, do a search for the Grab 2.0, or if you're an Interbank FX client, it's built into the platform as a custom indicator and also as a template. So there's two ways to do it. If you're not an IBFX client, that's fine. Go to my blog. If you are, go to the platform. It's much easier. And that's what I'm doing right here. I'm going right to the platform. All right. So I see there's a number of questions here. Let me tackle them real quick, and then we're going to wrap up. And then we have the second session, if I'm correct, at the top of the hour. So that's great. I could definitely use the voice break. Okay, cool. All right, let's skim through a couple of these questions. So, and gang, again, as I mentioned before, the turning point for any trader is being able to kind of put the blinders on. Work within the confines of your philosophy, which for me is Dow Theory. And then once you've found tools that satisfy the job, stop looking. You can't always keep looking. And while there are a number of great tools out there, I concur. I simply don't use them, not because they're not good, but because I already have tools that do the job for me. It's a big part of the way I look at the market. So it's not that I'm ignoring other tools or even ignoring well-meaning advice. At some point, I just don't need that next layer, okay? All right, so with all that being said, let's see, 20 period on my charts. Yes, that's a 20 period simple and 200 period simple along with my wave and grab candles. I use limit orders for my swing entries, as I mentioned. I'll use limit orders for that distribution fade as well. Yes, I do trade and I do write and do analysis, and I am absolutely blessed and lucky to get compensated for doing all of it. Okay, I do both. And I'm very lucky. I never, ever, ever take for granted how lucky I am to be able to be compensated for both. Let's see. Are these applicable in a 1-minute chart? You know, my only issue with 1-minute charts are the cost per trade sometimes become a little prohibitive. So I typically don't go smaller than a 5-minute in terms of the distance that prices could travel to reach one of my profit targets. Again, even though spreads have narrowed, the cost per trade, I think, becomes prohibitive on shorter-term time frames unless you have a situation where you think price could move far enough to justify the risk-reward. All right. Let's see. Again, if I have a trending market, that's probably my favorite way to trade. If I have that trend on the daily, I do prefer that. Okay. All right. So, yes, I'm going to go take that voice break right now, and I'll see those of you who will be coming back at the top of the hour. Thank you so much for your questions and for the discussion. I know I didn't nearly get to all the questions, but then again, that's why this is a 3-hour presentation. Again, thank you very much, gang, for your time. You can, the questions that I didn't get to, by the way, gang, I'm on Twitter like the rest of the planet is, and I'm also on Facebook. You can join me there. Again, I mentioned that I've got the blog over at the Daily Trading Edge. You can leave your questions, Daily Forex Trading Edge. You can leave your questions over there. You saw my blog at RagheeHorner.com. There's a number of places where I'm at. Of course, I'm a member over at forexstreet.net. So, wherever it is you want to go catch up with me via one of the myriad of social media platforms that are out there, please feel free to do so. You can also follow me over at ibfxconnect.com. So just a number of places. So I'm sure I'll see you all somewhere there. All right? Thank you again, gang, for your time. I really appreciate it. And for your questions and for just making time out in your day. All right. See you soon.